definitely no superwoman. I think a lot of people look at me and go, do you sleep? And I say 5 hours religiously every day. And if I have more than 5 hours, I'm a zombie for the rest of the day. So it's not a good thing for me to have 6 or 7 or 8 hours sleep. But that is the reality of, trying to grow a business at the same time as being a parent. Something has to give. I think when you start up a business, you can do it 2 ways. You can obviously go out and find a backer and have some level of capital in the group to allow for you to have those operational costs covered while you build, or you bootstrap your business and just not take a salary. And Tom and I chose to do the latter. We'd set out right from the beginning to want to become an investment management business. We had to ask ourselves, how were we going to achieve that? The best way we could think of was to build some level of balance sheet in the business and then start investing our own capital.
Today on the People Property Place podcast, I'm joined by Nadine Buckland, CEO of Zenzic Capital. With over 2 decades of advisory and investment experience, she co-founded Zenzic Capital in 2013 with Tom Lloyd-Jones to provide a range of structured financing solutions across the UK and Europe for single site and platform level funding, covering acquisition, development and opportunistic scenarios. The team had financed over £1.25 billion of real estate and asset-backed transactions across the alternative subsectors, including logistics, PBSA, BTR, hotels and leisure. Prior to founding Zenzic, Nadine held insolvency and transaction advisory roles at Horwath Clarke Whitehill, RSM Tenon and Baker Tilly. And it gives me great pleasure that she joins me on the podcast today. So Nadine, welcome.
Thank you so much for having me. It's a real pleasure to be here with you.
Not at all. Well, look, you've got a fascinating story and I can't wait to unpick it. And we'll come on to Zenzic and how you set the business up further in our conversation. But a place that I always like to start these chats is normally how and why did you get into real estate? But I know that's later for you.
Yeah.
Can you kind of go back to chapter 1 and just
sure.
tell me a little bit about what that
looked like? Yeah, sure. I think to start with, my background at home meant that my dad was pretty much on me from, I don't know, probably 14 years old, saying, what are you going to do career-wise? I think you should have your own business. And I think that was because he didn't have his own business and probably secretly had always wanted to do it. So it was almost trying to push that onto me. But I think from my perspective, it was probably the right thing to be asking me. It just probably was a bit too early. So not to disappoint him, but I went to university, didn't enjoy university twice. So decided to go into the workplace and used his background as the opportunity to start my career. And he was right in many respects. He read me perfectly in that, very early on, I recognised that whilst, I would probably be a hungry, driven individual as an employee, I probably had greater ambitions in life, and actually trying to control me in a corporate environment where I had to do certain things at certain times, of the day, was probably going to be, from a personality perspective, too much of a challenge. And that actually I wanted to be out winning business. And so that was really kind of the start, was probably in my early 20s, of saying to myself, what do I want to do in an entrepreneurial setting? How am I going to use the experience in my career that I'm going to, kind of build at this point in my life to enable that to happen? So it was a interesting decision-making journey in my early 20s, when you probably are at your least able to know yourself what you're going to be good at and how you're going to, create that for yourself in terms of, long-term career.
So what were you like growing up, and then what traits had your father kind of like identified in you?
Yeah.
That he thought, kind of put a bit of himself on there, but also like that he thought that you had the ability and personality to do it.
I think I was testing boundaries a lot in life. I was an only child, so I think, when you don't have those siblings around you to kind of control what you can do versus what someone else needs to do because they're more of a priority than you at that moment. It sort of allows, I suppose, in a positive way for you to kind of take advantage of all the situations that you're presented. You're not having to share in those situations. I think he saw that right from, in education, that whatever I always tested, I always pushed. If there was a point in maths that I was taught at school, I'd be why. Don't just tell me it's because it is. It's but tell me why we're doing it in that way. And so I think he always thought that it was going to probably be a challenge for me to be put into a situation where I couldn't test and I couldn't ask why. And his experience of working in corporate environments was that, a lot of the time you might be asked to push and challenge, but not early on in your career. You got to get to that point. And I think he saw that I was probably going to test too soon in my career to the point where people would say, we just need her to do that job, at the moment, and she can test as she gets experience,
But we don't need you coming in and telling us how to do things.
Yeah, or not even telling you how to do things, but just asking, questioning, a lot. I think I want those people now as I build the business, because I see there to be a real opportunity to harness what might be entrepreneurial talent at an early stage. And instead of and if they are individuals that want to go off and create their own business, then I would fully want to support that. But at the same time, it might be that they have that entrepreneurial spirit, but actually want to do it in the confines of a business that's got some level of established, nature to it. And so where possible now, that's the type of person I want to capture in the business. But I think when I started my career 20, odd years ago, and certainly in the environments that I was going into, there was a hierarchical structure. You had to go up certain levels in order to get to a position where I might be the person that's winning business or testing certain processes and reasons why we do things. And so you had to just accept that that's the modus operandi to get to there. And I just was an impatient individual. I think that was one of the things that my dad would have definitely said about me, was that I didn't want to wait for things. I wanted to, I'd rather make it happen, for myself than wait for it to happen.
And your parents were both in insolvency, is that right?
Yeah, that's right. Yeah, they both were in that sector. I think my father worked for NatWest and RBS Bad Bank. And so bizarrely now, he was a lender. I wish, he passed away, unfortunately, when I was in my early 20s. If only he was around now, it'd be, he'd be, I'm sure, a great source of, advice and all the wise years that he could kind of help me with certain points that I come across in business. But, it just so turns out that was the sector actually that he was in, but he was working. When we talk about insolvency, he was working with businesses that were unfortunately failing for whatever reason. And the bank was having to look at, how do we deal with that? Do we restructure? Do we put it into administration? Do we not? So that was his angle. And my mother was, working in the insolvency firms that I started off in my career in. So yeah, it was an environment at home of, businesses going wrong and lots of chat around how you resolve those. And I suppose I was around that from however early age and listening to it. And so probably a lot of that just seeped into my mind. And I use all of that experience now in Zenzic. So, yeah.
So you went to university not once, but twice, but didn't finish both courses.
No,
Is
correct.
that because you just had an insatiable appetite just to get going and start doing things and earning money rather than just kind of writing reports and essays?
I think that I realised that after a period, but I think that, if I'm honest, a lot of it was just down to the fact that it wasn't an environment that suited me well at that time in my life. I enjoyed being at home. I was someone that liked going out and socialising, but I didn't love the whole drinking culture that went with it. It was just not me as a person. And so creating friendships, I think when you're an only child, you value friendships a lot of the time. Well, certainly I did value those friendships almost like my brothers and sisters. And so to create that depth of friendship in a overnight is it just doesn't happen. But I wasn't ready for that. And so I think that I was looking for an environment where I could feel settled, and I didn't feel settled. And so it sort of got me thinking, okay, if I'm not going to feel comfortable, happy in these environments, where might I feel more comfortable and happy? And that was certainly being at home, and then saying to my parents, look, I'd rather just work, and start making some money and seeing where that takes me, rather than sort of furthering my education. At the time, I think like a lot of people in their 20s, early 20s, I didn't really know what I wanted to do. So it wasn't like I was going to university to do a particularly, vocational degree. I was studying politics and economics and, subjects that could have led anywhere. So I suppose on reflection, I sort of looked at it and said, well, if I can work and be happy, then that's a better thing for me. So
you landed at Baker Tilly, is that right?
Yeah, that's right.
What was that first role that you went on to do?
Yeah, I was an insolvency administrator, kind of the most junior of individuals in a business of that nature, working. I remember it was a time when we got involved in a lot of trading receiverships and being sent to places like Sheffield to a carpet factory. And at the time I was selling the carpet, in the factory, because we were trading as an administrator, we were trading the business, as a receiver rather, trading the business. So, you have to then work in the environment that business was operating in. And that particular business at the time was a carpet making factory. They sold carpet. So, off I was, sat with, a salesperson helping sell carpet at one point. You literally did every element of how a business operates you would see, and that was really interesting, actually. You don't realise, I think at an early age, I got to see the real inner workings of a often what were family operated businesses, the owners who were absolutely devastated. These could have been businesses, certainly in that sort of industry, wall making and carpet factories, that were all going into decline at that time. There were businesses there that were very, very old established businesses.
Third gen.
Exactly. And seeing those businesses fail and not being able to salvage them because the market was just moving from them was, a really difficult period. And it taught me a lot about the importance of relationship building with the management of those businesses, because they were going through pain, and you can't just not treat that with a level of care. And I think that's what sort of I transfer now into everything I do, is that, not just the business that I own, obviously I care a lot about that, but I care about the counterparties that we're providing capital to. It does mean sometimes that you can be quite emotionally invested. And so, you've got to try and balance that a bit, but actually sometimes that passion to me is what can drive fantastic investing. So I sort of, really try and use that now to be a big strength of mine in the world that I'm operating in.
So you joined Baker Tilly in an insolvency administration role, and you're working with carpet businesses or wool manufacturing businesses that went that were kind of struggling, and you were kind of roped in to help out with sales or kind of work in accounts or different parts of the business?
Yeah, the idea was always to then work out where is the value opportunity within those businesses. What do we do with this business? Are we selling it? Is there a market for it? Is there not a market for it? Therefore, are we having to break it up and sell what we can to be able to return some level of capital to any creditors that are available? That is the role of of anyone operating in the insolvency world. So, obviously at a very junior level, you're a cog in a wheel helping that happen. Obviously, you're not the person making the decisions about what to do from a business plan perspective with those organisations, but you saw it. These were small teams that were put onto these businesses. So you were watching the partners operate, you were seeing how they behaved, you were watching how they were making those decisions about what to do with the business. And sometimes they were very harsh decisions that had to be made, but it was for the benefit of the creditors, and that's always what they have to do. It's still obviously a big part of what an insolvency firm does now, but trading receiverships are certainly a thing of the past. You don't see those happening now.
And from your discussions at the dinner table with your parents growing up, did you kind of learn very early on the ability to kind of separate the emotional from the rational?
Yeah, I think I think if you're not passionate about something, that's then impossible for you to grow it. So owners that are not individuals that love what they do, typically, they may not have that drive to be able to see through what might be difficult times. You've got to have a level of resilience that, to be frank, even I question sometimes how am I this resilient? So I think it's that emotion and that passion that drives you, but you have obviously got to be able to take a step back sometimes and look at, we've got to make specific decisions that are for the benefit of others. You have to be able to separate. And certainly, I think a lot of my friends would say I'm very good at compartmentalizing things in my personal life as well as my work life. And I think that is a skill, actually. I don't think it's something that you can't learn to do. I do think you can learn it, but there are some people that are natural at it and some people that need to learn it. I was just natural at it. But maybe it is because, I watched and observed my parents behaving in that way as I was growing up. So it was maybe a learnt behaviour, if you know what I mean.
How long were you at Baker Tilly for? And then what prompted the move to RSM Tenon?
I was at Baker Tilly for, I think, probably 2 years. And then I moved roles like lots of people in their early 20s. I was not, I wouldn't say I was a job hopper, but I was not someone that was packing in 10 years into firms. And I think that was because I really wasn't sure what that I wanted to be in those environments long term. So you were always searching for something, that you weren't going to get in those businesses. That was the reality. I was not going to achieve what I probably, didn't necessarily realise at 23 or 24 what I ultimately wanted to achieve. But there was something about me that was just not getting what I needed from those time. From those organisations. So I did move, but I think that you can learn from moving. I think when people join Zenzic and then 24 months later, 36 months later, they're potentially resigning because a flashy job over here, comes about that looks interesting. I don't sit down and try and counter those individuals. The first thing I say is, what's driving the decision making? I want to understand what's important to them. And obviously you do whatever you can as a business to prevent that eventuality actually happening in the first place. But I've always found that, countering someone's decision to leave is probably not going to end in the long-term result that you would want. So, I try to be quite supportive of people's decision to move, and you can learn a lot in your early years by moving organisations and seeing how different organisations operate. So I feel like every job I did at that age, I learned something, and it's whether or not you use that is another matter. But, it's what you do with it.
Some people get petrified at the thought of moving or having a choppy CV, whereas it's much better to own it.
Yes,
and be proactive around being curious and looking to find a new environment where you can learn and skill stack and progress, rather than being miserable in a job that you're rudderless and you're not going anywhere. So I think people will really enjoy hearing that.
I think as well, we debate this quite often. When you get a CV through the door, you might see someone who's done 2 years, and there will be people at Zenzic that will say, that seems like a lot of moves. And, what are they going to stay here for more than 2 years? And I say, well, depends what they're looking for in life and what their character is and what can they bring to us in that 2 years. If all we're going to get from them is a 2-year tenure, but in that 2 years, they deliver brilliantly, they bring something to us that somebody else is not, then we should harness that, take what we can over that period, but also be supportive. And you never know where that relationship might lead to. They may go to another firm, which we may be able to collaborate with. They may decide to set up on their own, and we may want to support that. So I think maybe because of the type of person I was, I'm not someone who's negative to that, whereas I think there are people that are a bit more traditional in life and say, 4 years minimum on a CV we want to see before a move. And if they've moved much more than that, then we'll just disregard them. I don't think that's always the right decision when you're hiring.
You want to get to the bottom of the why behind each decision.
Yeah, and you want the best people. Even if those best people aren't with you forever and ever, you want to use those people as you grow. We're growing a business. We're not there, where I would like to get it yet. When you get there, maybe your hiring strategy and your thesis around the type of people you want in your business changes. For me, I definitely want that hunger and desire to build. And when you hire hunger and people with that hunger and desire, inevitably some of those people are going to want their own firms, for example. And so it's how you capture the skills that they bring over that period of time that they're with you.
What skills had you acquired at that stage before you set Zenzic up? And if you were to be self-reflective, what were you really good at? What were your strengths, and then where were your kind of weaknesses?
Mm-hmm. Definitely in the kind of being able to build rapport and drive relationships very quickly was my greatest strength, and still I think is now. I think you either have the natural ability to create a relationship with someone in an instant, or you don't. And I just so happened that I think my natural personality meant that was something that I tried to sort of utilise in all the parts of the career journey that you've just said that wasn't really, to be fair, going too quickly anywhere, but that side of my personality, I think, was one of the things that I wanted to utilise as part of growing a business. Obviously, through my career, you learn very much about how a business operates, what it takes to make a business a success. What are the risks? How do you mitigate those risks? So how to operate a business is certainly what I learned through that journey. And actually, that is a piece that I think has been a real benefit to growing Zenzic, because a lot of people will often, in our industry, certainly from what I've observed, have worked in the larger corporate investment management businesses, have never actually operated a company when they might go out and raise capital and be the founder of a new fund. And, you can be a great deal person, but not a great business operator. So I think having had that background, it was helpful for me when I founded Zenzic to have at least observed what I thought were perhaps sometimes, things that went well and things that didn't go so well for businesses, and how I would maybe then operate my own.
Because you were parachuted into lots of different firms with lots of different challenges at a really stressful time.
Exactly.
And you're trying to really quickly work out what's viable, what isn't.
Exactly.
What can we save, what can we protect, what can we double down on and grow. And so you had to be really commercial and really sharp. And I guess you developed your own playbook of what works and what doesn't over time.
Yeah, over time. Yeah, exactly. I think my commercial decision-making brain was always something that I think was there in the background, but obviously hadn't necessarily been harnessed in the career that I, at that time, had been building. When I founded Zenzic, I quickly realised that there is sometimes you sometimes have a sixth sense and a gut feel to whether or not you're making the right decision or the wrong decision, and so and how do you use that? That is sometimes just what is being commercial. Being able to make decisions in some respects is a big part of being able to be commercial. You can't run a business if you can't make decisions quickly sometimes, And so, I think that was I think when I look back on the creation of Zenzic, was it bold and was it brave at 32 to go into an industry that I hadn't had a track record in, but I had a background in being able to originate transactions, meet people, network. How do I use that and, create revenue from it? That was obviously the kind of start of my thought process. How do I make money from this skill set that I have? And I combined that obviously in then joining forces with Tom Lloyd-Jones, who I founded Zenzic with, who had a very different background to me. And, a combination of those skills is what's obviously enabled Zenzic to grow to the space it has done now.
So how did you meet Tom, and
Sure.
what skill set does he bring to the party?
Well, very different skill set. He, went to Cambridge, converted to do a law degree, and then ended up working for McFarlane's in first, I think, in tax structured finance, and then moved into fund structuring and then on to transactional structuring. And, that background of skill set, that structuring skill set was something that I obviously didn't have as a skill. But if you're going to look at ways in which you can put transactions together, the structuring element is absolutely key. And still to this day now is a big USP of Zenzic is the in-house ability to structure and think on our feet, solution-led, is how we approach our transactions, how we approach as the market as an investor. So when we met through work, I could see that, albeit that we weren't working for the same firm, I could see that he had a brain that operated in a very commercial way within the sphere that he was in, which actually was quite an unusual characteristic to see. And at the same time, he brought something in terms of skill set that I was not able to at the time have. So it was a nice meeting of minds in the respect that we saw gap in the market, and we felt that as a combination of skills, we could take advantage of that at that time.
Earlier on in this conversation, you said earlier on in your career, you didn't quite know where and what you wanted to do.
Yeah. It was meeting together, I think, that we put that together because we could see these pockets of opportunity in the market, which was post-GFC, the emergence of the kind of credit fund market that we see now, which obviously has grown substantially over the last 10 years. But then 13 years ago, it was still very much an emerging environment. We're still nowhere near the States in terms of non-bank lending, but, it's definitely come on leaps and bounds in the UK over that period. And so when we were talking and deliberating, how could we utilise our skills and really make money in that space, we saw this gap for becoming an opportunistic credit advisor. I had a background, obviously, with the insolvency of businesses and contacts where there were plenty of people that wanted capital. And I knew the market because of the firms that we'd exited to the non-bank lending market, these alternatives to private equity. I knew who the counterparties were that had the capital to deploy into those types of deals. Tom knew how those funds were structured, how the types of deals that they would want to do. And so he could deploy that skill set together with mine into crafting transactions for those counterparties that were, at that time, a lot of them had capital to deploy in quite big swathes, but they didn't have the boots on the ground necessarily to deploy it in the speed that they wanted to. So we felt, looking at the market of corporate finance advisors at the time, that there weren't a huge amount of people that really understood that market. They understood private equity and they understood lending, and most of that was being done within banks. Working with the opportunistic credit or sort of alternative lending sectors, a lot of these firms were at that time quite new. People didn't even know who some of these firms were. Even Ares back then, who doesn't know Ares now? But then they were actually in the UK still in their infancy of growth. And so, those relationships with people in those firms where Tom had perhaps structured, one of their funds and knew all the counterparties in there, we were able to harness those relationships with mine and put it together and start making money. And I think we said, if in the first year we didn't place a transaction that generated, some income, then we'd obviously revisit. And I think at the end of the first year, we'd closed on 2 or 3 transactions that had generated, I think, just over $1 million in revenue. And so we felt that we had a semblance of a business to carry on with. And to be frank, we probably carried on talking in that way for at least 3 years before we sort of said, okay, we don't need to ask ourselves the question, is this, have we got something here?
Have we got the ability?
Have we got the ability to keep this going?
Underdog mentality.
Yeah, exactly.
And that was kind of broad cross-section. It wasn't just specifically real estate at that stage.
Correct. Yeah. We were all asset backed. I think we felt that at the time we talked about being sector specific. I think that from the day that Tom and I met, I don't feel like we've ever stopped talking about the market opportunity, where we see it, how we harness it. It feels like it's on repeat for us, on a daily basis. And so at that time, we felt that the market opportunity for us was to be far broader. We wanted as wide a market as we could get in terms of borrowers or, owners of businesses that wanted capital. And at the time, a lot of these firms weren't always very sector specific. They were often quite broad, and they were saying, look, we're sector agnostic. What we are is good at finding solutions for the capital that those businesses needed. I think over the last 10 years, you've seen far more of those firms that were truly opportunistic become more sector specific. There's still clearly huge opportunistic credit strategies where they're totally broad and they can pretty much, go in and invest into anything that they see value in. And, honestly, if I could get there where I didn't have to be, specifically real estate over time, I could see that being our trajectory. I'd like to get back to, at some point, being able to go wider than real estate. But right now, I think we have to harness the experience that we gained over the 6 years of building an advisory practice and in that space. And when you looked at those deals, when we took a step back and said, if we're going to go and launch a strategy now with the track record of experience that we've got at that point, where have the deals been, mainly placed? They'd all really had an underpinning of real estate. There was probably 70% of the transactions had an underpinning of real estate. It made utter sense for us to then take the business into an opportunistic credit strategy within real estate. And I think there's enough of a market there for that to be, pretty much our future for the next at least, 5-10 years. But I have ambitions beyond that. I'm not looking to create a business that's here just for the short term. I'd quite like to die and the business still be going, and the death be in my 80s and not, not anytime soon.
That somehow doesn't surprise me.
Yeah.
So how did you make that pivot?
That leap.
Because, that's the challenge, right? How did you start working and pivoting the business? Obviously, you'd done a lot of transactions that underlying had a real estate component or exposure to it. But how did you really transform that focus? And how did you build that track record?
So around year 4, when we founded the business, we'd set out right from the beginning to want to become an investment management business. We had to ask ourselves, how were we going to achieve that? The best way we could think of was to build some level of balance sheet in the business and then start investing our own capital. So really, right from the start, that's what we set out to achieve. Around year 4, we'd created enough of a balance sheet to begin investing. We'd seen at that time a huge rise in inquiries as to whether we knew anyone that would invest in mezzanine positions in real estate development transactions, predominantly backing real estate residential developers in the UK. Obviously, these weren't transactions that were right for us as an advisor. Ticket sizes were often, anywhere from 500k upwards often. And so, as an advisor, we wouldn't have been able to add value to those businesses, and our fees, to be frank, would have been outsized to the deals that we were working on. So it just wasn't a market for us to act on. But it was perhaps the right market, we felt, for us to start utilising our balance sheet capital to invest in. Of course, at the time, interest rates were very low, and mezzanine rates were in real estate development were sort of into the 18s and 20s. So you were getting a very nice return for our balance sheet capital. And this wasn't a game that we were playing with our money to just sort of try and make a bit more. We set out right from the start to say, this we know is the beginnings of our track record. We want to get here. The track record needs to be able to support us getting to there. So we've got to be careful about where we invest, who we invest with. We can't lose money. We've got to be in a position where every pound works for us. And so right from the outset of making that transitional change, it was, how do we scale this business? What processes, procedures? I mean, people, I think, internally thought we were crazy for running full-blown credit papers, 3-stage investment committees for a £500,000 loan. Mezzanine check. I honestly think that, at the time, people just thought, what, why?
It's your money, right?
We can just have this chat around a table and it's our cash. So, but
it's the start of that process and that institutional mindset, right?
Yeah, it was never the aim to sort of just have some balance sheet cash that we were investing. It was the aim was to scale. So you want to be able to show right from the beginning, in my view, that you have a very strong sense of responsible investing. And so, that's what we created, was that process. I also think that some of the borrowers thought that this was a very heavy going process. But what we kept on saying to borrowers, what we want to try and do at that time was institutionalize mezzanine financing within a real estate development context. At the time, if you looked back then, a lot of mezzanine lending was done by high net worths, maybe some family offices, individuals that didn't necessarily need to deploy their money into it. They just saw it as an opportunity. As a result, developers often found themselves right at the last minute being left at the altar, not being able to close on their transaction because the individual had changed their mind. What we were trying to do was provide certainty to those individuals. That is still what we try, very much to do now is, if we've issued a term sheet, we'd have done a lot of upfront due diligence. We would have, diligenced the manager, we'd have diligenced the transaction, would have probably gone above and beyond, in some cases, what you might do to just issue terms, because I always want to only issue terms if we genuinely want to do the transaction. You might uncover things during due diligence, post-term sheet stage that says, actually, unfortunately, this is not a deal as it turns out to be that was presented to us in the first place. But still, as much as you can, I like the team to do the heavy lifting in advance. And we did that right from the outset.
Quick one from me. If you haven't already subscribed or followed this show on the podcast or app where you listen or watch, please do. It takes 10 seconds and helps tremendously. I've got really big plans for the People Property Place podcast, and that one small action really, really helps grow the show and the presence and enables us to keep doing what we're doing. So if you haven't already, please follow or like on the platform you watch or listen to. Thanks so much. At what stage did you stop, or you kind of drop the advisory work and then start doubling down on kind of more lending, and then kind of pivot to fundraising and institutionalizing the business one step further?
Yeah, well, we around 3 years ago now, 2.5 years ago, we stopped all of the advisory business. So for a while, we were building the book through residential development. We saw that market opportunity really very early on, and we still very much fundamentally believe in the opportunity set in the UK for residential development. Obviously, now that expands to BTR, co-living, single family homes. Yeah,
I was going to say, which specific part of the resi market were you focused on?
But at that time, it was working with home builders, potentially sometimes building 20 flats, could have been 10 flats, could have been 3 houses. But obviously now, as we've grown, the transactional sizes have increased. And so, typically when we're operating in that market, we're still operating sometimes with smaller owner operators of development companies if we're investing in that space, but we're also obviously going into bigger ticket transactions. I mean, if we talk about residential, we still, we're so passionate about that space. I mean, we love working with I love working with smaller firms that really want to grow, and harnessing people. It's back to that desire and hunger. I look for that in pretty much everything that we do. So I still love working with those smaller developers that are looking to grow their businesses. Obviously, given the market changes over that period of time, we've moved away from mezzanine lending. If we go into that sphere now, it's very much typically in a whole loan space. We very much are passionate still about the home building space, because there is such a deficit of housing in the UK, and specifically affordable. We've never ever invested into anything that is not ticking the affordable box. So, back when we first started, there was the Help to Buy scheme that was run by the government to allow people to buy homes. That obviously therefore had a certain pounds per square foot, typically, that meant that it fell into that bracket. So very early on, that's where we focused, was only backing developers that aimed to deliver homes that were fit, were fit for Help to Buy. And even when Help to Buy was removed, we've stuck firmly in that space. So we've never changed those parameters.
Is that with business? Is that with developers that have got outsized Section 106 agreements in place, or?
No, I mean there's affordable and affordable, if you know what I mean. I don't know how better to describe that. So you've got the Section 106 piece of affordable, but then you've also just got a build to sell product that fits the affordable bracket, i.e. you've got a broad brush range of individuals that can afford to buy that home, and we always want to sit within those brackets.
Kind of accessible.
Yes, exactly, very accessible, and right for the market locations that we're investing into. When you look at Section 106, I think it's a really interesting way in which the government are dealing with what needs to be often a group of individuals that ultimately desperately want to get on the ladder, and I feel like there's so much more that could be done in that space. I mean, it's probably for another interview, but I think I'm a big supporter of it. I don't always know that Section 106 routes are the right way to deliver the affordable housing needs that the country has, but I think that it's certainly a solution to help. But yeah, so we're very focused on that. And that was never driven from a particularly ESG focus. We didn't start with the ESG angle and say to ourselves, because every institution, that's allocating capital to an investment management business often wants to hear about your ESG policy. We didn't work backwards from that and then say, right, well, we really want to go into that space. What we saw was a market opportunity very early on. Now, obviously, there's more people in that world, but we still want to be in that space. We're still allocating capital there. But of course, now there is great opportunity in co-living, BTR, and co-living very specifically, I'm very, very keen to see grow as a sector in the UK. I think there's great opportunity in that space. I think there's opportunity now to invest in that kind of second generation of co-living, and kind
of repositioning existing.
Either repositioning existing or building brand new stock, but building to space standards, being very innovative about the layouts of the individual rooms that obviously people are renting, and creating real communities for young professionals in some cases. To be frank, you're seeing co-living being utilised by international students as well, of course. But that mix of individuals that are effectively either coming to the ends of their university career or starting in their careers, I think it's a real opportunity to capitalise on. People want better quality of housing, can't necessarily afford to buy their own home in the affordable pace. They need to build up their capital behind them to be able to do that. I think co-living therefore offers a great opportunity for those people to live in a really nice environment, meet people, and enjoy their youth and their young careers. So yeah, I'm quite passionate about that area.
Can you just give me or give the listeners an overview of Zenzic Capital today as it stands, if they haven't heard or come across your business? How many people are in the business, and
Sure.
Just talk about the funds and the types of deals you do.
Yeah, so Zenzic Capital now, its focus is it's our opportunistic credit strategy. Within that, we have what we've discussed. So we have a real estate development strategy. We invest into growth opportunities with businesses that we believe have the backbone to be able to take their firm from A to B with our capital, and the B being an institutional exit, perhaps of a portfolio of assets. And then we have our focus on liquidity opportunities. Huge wall of refinancing going on, and not enough capital to meet the demands of that. A lot of capital dislocation across the markets, certainly in areas of Europe. Seeing big opportunity in Italy, France, and Spain, as well as the UK, and what we try to do is support the SME owners and operators of real estate within those markets. So as a business, as it stands now, we have a team of around 22, I think it is now, individuals who cover everything from, your underwriting and origination of new transactions through to the asset management piece. I think for us, that's been a big focus, is getting that team right. You want to be able to generate great returns. We're delivering a 19.6 IRR or gross on realised transactions to date, and so we obviously, as a business, want to continue to deliver in that top quartile of investment returns. So to do that, you've got to have a great team. You've got to have people that are passionate about what they're doing. You've got to have people that care. I posted on LinkedIn this morning about exactly that the people that are really successful in life tend to be the people that care the most about what they're doing every day. So, I have a great team that seem to really be behind me and Tom and want to see the business a success. We, as a firm, look to capitalise where possible on situations that are occurring in certain asset classes that we see as being, I suppose, those that are nascent maybe within real estate. So, we invest in student accommodation, we invest in self-storage, we'll invest in hospitality. Ultimately, we'll go where we see the greatest opportunity sets. Obviously, we've talked already about residential. And so what we try to do is almost have a bit of a private equity ethos to how we go about creating that origination. And so if you joined Zenzic, for example, as an employee, you would not be, pigeonholed to a particular sector. You would be told as an originator, these are the types of transactions that, we want to be doing within the firm, within the fund. We therefore allow them to go out and find the counterparties in sectors that they really feel have great, strong fundamentals for growth. And so we try to give people quite a lot of autonomy in that respect. At the same time, of course, you're constantly thinking about track record. We're building our AUM and, I'm out capital raising. It feels like on a daily basis is my main focus at the moment, outside of obviously the day job of running the company and thinking about the strategy and, all the things that a CEO would typically get involved in. And so every conversation that you have with a potential investor and an allocator of capital of some form, you're talking to your track record. And so, whilst you're building an opportunistic credit strategy, we're also always thinking about, does that deal represent this strategy in the best way that it can? And does it also tick all our boxes when it comes to our moral compass, what we believe to be, the right type of underlying borrowers or, management team. And that's really, I think, what we've always been very passionate about right from the day that we started doing this small ticket mezzanine lending was, who is our underlying counterparty that is going to be the chaperone of our capital over that period of time. You can put great covenants in place and do bespoke loans. You can oversee them, as much as you possibly can. But at the end of the day, the relationship that you've created with your underlying sponsor is key to that going well, and so that's a great emphasis of ours. So I think you would see that knitted together as part of a team and to be able to deliver our strategy.
And do you do that in sidecarts or separate accounts with particular investors, but you've also got a £500 million fund that you have raised? And how hard has it been to raise a debut fund, given the challenges of kind of capital raising in this type of environment?
So our capital at the moment is raised through mainly an inheritance tax vehicle in the UK that benefits from the use of business relief. So if you've heard of people like Octopus Real Estate, Time Investment Group, they have very similar structures to raise capital. So most of our capital to date is ultimately retail capital that we've raised. We haven't moved yet into raising huge amounts of institutional capital. That is the journey that we're on at the moment. We have got great relationships with other GPs, co-investment strategies with those GPs and some managed accounts. And so we utilise all of that capital to invest in our strategy. And it's a journey, it's a really interesting marketplace for capital raising at the moment. If we talk about challenges that I face on a day-to-day basis, it's how we go about raising that capital, who we talk to. And, at the moment, everyone talks about the fact that, huge amounts of capital are going to the very, very large GPs. There's a lot of middle ground that's not raising any money at all. And then you might have firms like ours that perhaps are more emerging, that are trying to really position themselves as being very nimble, and sometimes are being able to capitalise on that and raise capital. And I think we're very much in that bracket at the moment. Obviously, I have ambition to grow it to become a behemoth. I would be lying if I didn't. But the allocators of capital in the current climate are not paid to take the risk of allocating to an emerging manager.
You're not going to get fired to go give some money to Blackstone or BlackRock or Brookfield, right?
Exactly. And they take the risk of allocating to an emerging manager, but they don't take the upside. I'm not sure what the solution is to that for those allocators. So what we do at the moment is we focus on the firms that can allocate to emerging managers, and that's where we're having the most success, is the businesses that are chaperoning and almost taking that risk off some of those large LPs by being the counterparties that are going out and seeking the emerging managers of the future, and that's where my focus at the moment is. But it's a challenge.
Have you struggled getting your head around real estate and the transition into real estate as kind of a second career, in terms of piecing it all together, but then also being able to scrutinise and work out the kind of the GPs or the managers that you work with as well? Or has that come quite easily because you've just had to pick up and learn various different industries really quickly previously?
Yeah, I think when we were obviously acting as an advisor, the skill there is being able to, as you say, very quickly get your mind around an industry that you may never have looked at before. And actually, that is a real skill. It's not something that comes easily to lots of people. A lot of people get a lot of comfort from not cookie cutter approach, investing, but certainly sticking within a sector and knowing that market intimately. We kind of take a bit more, even within real estate, we're not sector specific. So even with the confines of saying we're only investing in real estate, we will look at one day a deal in, could be a hotel in Italy that needs some form of repositioning. The next day we might be looking at a life sciences transaction. And, and you're not ever going to be a master in depth of those sectors. That's why you have to partner with best-in-class managers, operators within those sectors, and take some of their knowledge alongside yours. Obviously, every time you do a deal in a new sector, you learn it to the point where you're never going to be knowing everything, the oracle in it, but you know it quite well because you have to delve into those sectors in such a deep way. So I think the real estate piece was a natural decision for us. As I said, 70% of the deals that we had ultimately ended up advising on all had an underpinning of real estate, and they were very, very, very various different sectors that we ended up advising on within real estate, which led to obviously the decision. It was a pretty easy decision, to be honest, to say, look, if we're going to focus, let's focus in the real estate space. And
one of those partners in the press recently, Torsion Group, even.
Yeah,
sorry,
that's okay.
Can you just talk about that for a moment?
Yeah, I mean, Dan Spencer, who owns and founded Torsion, he was an advisory client of ours very early on into the life of Zenzic. So actually that is probably now a 9-10 year relationship with him. And he's been on quite the journey of growth over that period of time. We have a great relationship. I feel like we talk sometimes just as much as Tom and I talk on some days, but he is exactly what I always look for in that underlying sponsor, of someone who is, driven, motivated, passionate about what they do, really believes in his business, is a solution-led individual. So, if we need to try and find a way to acquire an asset, he doesn't necessarily, have the depth of capital that he needs in order to acquire it just by himself. He obviously then comes to us and says, could this be an asset for the JV? And so, we are always talking about ways in which we can do more together, how we grow that JV in the student accommodation space. He's an excellent individual when it comes to the knowledge in the student accommodation sphere. He, his business, the foundations of a lot of his construction business grew on developing student accommodation or contracting in the student accommodation sphere. Obviously then became contractor developer and has grown his business in the development space since then, as well as growing a construction business. So, he's my kind of ideal candidate, as it were, when it comes to someone who really knows their sector and doesn't just know it from a, knows how to build it, individual. He knows how to operate as well. And, he's building an operating business alongside it. So, has the full suite of, that operational skill set behind him. And, student accommodation is a highly involved operational environment of real estate. It takes a lot of work to understand the different nuances of the different cities that you're investing in, how those cities are dealing with either student flow coming in that's increasing or decreasing, and your student accommodation asset is going to be affected by those flows. So how do we capitalize on those flows, or how do we deal with situations if, for example, you're invested in a city for whatever reason that particular year has less students or has new stock coming in, and so there's more to absorb. You're constantly looking at the net operating income of an asset, how to sweat those assets to ideally achieve as much profit as you can within those transactions that you have invested in. So, all the time, that is the conversation that you're having. And that's where the strength of relationship, with who you pick to put your capital with is so important, because, those conversations sometimes will be tough decisions to make. And you want to be in a position where you're collaborating. Yes, you are a capital partner. And yes, sometimes as the provider of that capital, you might have to make some difficult decisions with the management team that you have backed. And it may not be in their favour, because we obviously always have to have in our mind, our investor is, or investors rather, are the most important, piece of the puzzle for us. So, you're always making decisions thinking of them first, just as we did when we started investing our own money. Of course, every single pound was ours, and when we first started, and that ethos is will always be there within the firm. So yeah,
you set Zenzic up, I think you mentioned when you were 32 years old.
Yeah.
What was the personal cost and personal risk at that stage of doing it? And then the second part of that question is, I know you've got a 6 and a 7-year-old as well. How are you the best mum you possibly can be to your kids while running Zenzic?
Okay, so answering the first question, the personal cost. I mean, I think when you start up a business, you can do it two ways. You can obviously go out and find a backer and have some level of capital in the group to allow for you to have those operational costs covered while you build, or you bootstrap your business and just not take a salary. And Tom and I chose to do the latter. I think, in fact, actually, we never even thought about going out and finding a backer for Zenzic. We just right from the outset said, as I suggested, if we don't make any money in the first year, then we're going to need to probably look back at, what we do career-wise and going back and find jobs. So, the personal cost was more than just financial, because obviously in the end we chose actually to not take salaries for almost 4 years whilst we built that balance sheet because of what we were trying to achieve. It also, put on a lot of demands on our other halves. We're not married to each other. We've got, individual partners that that we have to sort of work around, and they had to be quite supportive of this journey. I think very early on into the business, Tom had, his wife had their first child. I'd been married a while by then, because I met my other half when I was 20. We hadn't had children, and so creating the business meant that we had to think twice about what was that journey going to look like. Probably not now to have children. Let's wait and see how much we can build the business before we go and embark on that journey. So it was a financial cost, and in some respects obviously an emotional cost, probably more so for our other halves than it was for us. I think when you're in it, and you're trying to grow it, you're not always necessarily thinking of the impact that might have on all the people that are around you. But, we were both obviously very lucky. We had, true supportive partners in life. So, that clearly helped a lot. And then obviously you've got your kind of network around you as well, that goes beyond just your immediate partner, family and friends. But, there was a cost for them as well, of course, of obviously being a bit wary of, are we making the right decision? Is this going to go in the direction that we hope it's going to? Are we going to end up, 2 years into this having, maybe created a bit of money on year one, but not necessarily creating enough money in year two, and then, potentially be in a position where we'd have to kind of go back a rung in our own individual careers that we'd been growing up until that point. So, yeah, I think there was quite a lot of risk in creating it. But at the same time, we were 32. We didn't have, huge amounts of, things in our lives like, school fees or, costs of living that just have increased, over that period of time. So I suppose, in that respect, we were a little bit lucky that we both had some capital behind us that allowed us to take that year to see where it went. And then in terms of the second part, well, this is an interesting question, because I think if you ask my children, how is mummy like, how or is she even a good mummy, I think is the first question. Obviously I have an amazing relationship with my children, as you would hope that any mother would. Is it difficult? It's really difficult. It's really hard. I think you want to be all-encompassing as a parent, and you want to be all-encompassing as a business owner. And, the reality is when you have children, having founded a business, I don't know what it's like the other way around, of course, because I didn't do it that way. But, if you create a business and then choose to have children, you create a baby, and I appreciate that the one thing that we keep saying to ourselves internally is, you don't want to treat a company like a child is to you, because with a child, it's unconditional love. With a business, you have to be able to take a step back and constantly look at, is this business going in the right direction? Can we take it to the next level? Because if we can't, then, we shouldn't be looking at this as an unconditional love moment. You have to be able to be commercial.
Be rational with your insolvency hat on.
Exactly. You have to take the emotion out of it and say, is this going in the right direction, and are we the right people to take it to that next stage? With a child, obviously, that it's different, definitely different. But I think being a female leader of a business in this sphere, I get to kind of go to female investment, forums and panels, and you meet a lot of women in a either similar role to me, and maybe they're in a larger corporate, in a investment decision making role, or whatever it might be. And nearly in every circumstance, I think there are two different types of people around the table. There's the person that's really genuinely trying to make life work without any additional support. So, they'll do the school run, and then they'll go into the office, and then they'll get back for the school run, and then they'll log onto their computers until, whatever o'clock at night it is to get the work done in the timeframes that they've been focused on parenting. And then you have me, and I'm in the camp of, I have my mother lives with me in an annex, has done now for 15 years. So even prior to having children, she was with me. But obviously, having had children, I benefit from her being around, and they have an exceptionally great relationship with her. I have a nanny. I have a husband who's, incredibly supportive, and whilst he's in a big role in a firm, he still makes himself available to support the bookends of the day when it's necessary. So you have to work as a team at this, and I think you ideally want always to be all in on both, and the reality is you can't be all in on both. You have to learn when you have children to be able to be comfortable with being slightly out on both, because you can't be everything. I'm definitely no superwoman. I think a lot of people look at me and go, do you sleep? And I say 5 hours religiously every day. And if I have more than 5 hours, I'm a zombie for the rest of the day. So So it's not a good thing for me to have 6 or 7 or 8 hours sleep. But that is the reality of, trying to grow a business at the same time as being a parent. Something has to give. For me, sleep. For others, something else.
So as we look to kind of draw this to a close, a question that I ask everyone on the podcast is, if I gave you £500 million worth of capital, which, by the way, I don't think is going to quench your thirst and the appetite you have for Zenzic, but an initial seed 500 million.
I would take it.
You would take it.
If you offered it to me today.
And if I had it. Who are the people, what property and which place would you look to deploy that capital?
Yeah. So I think this is a great line to be able to talk about the reasons why we have the strategy that we have, because, obviously I'm truly passionate about what we invest in now, and I wouldn't change, the direction of travel of the business or the types of transactions that we want to be doing as a firm, because that ultimately is a strategy driven by me and Tom. So we've crafted that because we're passionate about it. I think where or how I would allocate the capital is the focus for me. And it's back to, talking of Dan Spencer at Torsion. It's about the quality of the counterparties in which you are investing in, and seeking the individuals that have that thirst, have that drive, have that hunger to grow their companies, or, it could be stabilise their businesses if, for example, we're doing a transaction that perhaps involves some form of restructuring. But what it always comes back down to for me is the qualitative analysis of a deal. You can scenario analysis for Armageddon. You can look at your comps analysis. You can spend hours, and our team do, of course, because, you're investing responsibly, to decide whether or not you want to make an investment in a deal. But the reality is that once that deal executes, it's about, in my view, a big part of it anyway, is relationship, and how you get the best out of the founders or CEOs that you are operating with to either restructure a business, grow a company. And of course, because we often structure in a debt capacity, we aren't necessarily always taking board seats on every deal. But I make it really clear right from the start when we're working with those counterparties that we aren't going to be, and I personally am not going to be, someone who's going to sit in the back seat and observe from afar. I want to be, on calls if it's, right for it every day if we need to, if we're trying to make decisions about a new acquisition. If it's once a month, fine, because it's maybe an asset that perhaps is more of a stabilised asset and we've done some sort of refinancing exercise for a short period. But either way, it's those transparent relationships that we end up with at the end of it that I think allows us to maximise the returns, and also to create the exits. I feel really passionate, honestly passionate about supporting talent in the industry, and that talent doesn't mean youth always. It just means people that have a true ambition and leave no stone unturned. They're true entrepreneurs within their sphere, and I think you can do very well by having a very strong boundary of who those underlying management teams are that you're providing capital to. And so when my team bring a deal to investment committee, that is my focus. I look obviously at the analysis and I'll, delve into the model, and before I might ask more questions of the information that's been provided so that I've got a good background to the deal that we're making a decision on. And obviously we're small enough that at the moment I'm often very involved in those deals, on structuring, on origination, on, working with the underlying sponsors, at an early stage in the deal life cycle. But ultimately we have to make decisions at investment committee that fundamentally are pretty important, right? You're potentially making a decision to invest 20 million, 30 million with a counterparty. To me, and I'm sure there are parties out there doing much bigger ticket transactions, but to me that is a lot of capital, and I don't want to ever lose a pound. So how do I ensure against that? So if it was given 500 million, I would invest it in the strategy, of course, that we are passionate about. But the key for me will be who it's with.
Well, look, Nadine, you've got a fascinating background, a really, really interesting story. And I think that, the listeners are going to absolutely love, well, I know they love entrepreneurs, but female entrepreneurs, powerhouses who kind of disrupt and drive, innovate, is brilliant, and we need more ladies like you in our sector really driving things forward. So thank you for sharing a little bit about your background story, and I'm really excited to see what you and the team go on to do at Zenzic.
Thank you so much. I'm truly grateful for being able to spend the time with you. It's been a great interview to kind of push me on certain points that perhaps sometimes I don't get to explore too often on my brain on a daily basis. So it's been great. Thank you.
Thanks for listening to this week's episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockborn.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you next time.